Hey everyone, I'm here with Sarah, our tax expert, because I got a really interesting question from a viewer.
What's the question?
Someone inherited their grandmother's house, but when they sold it, they lost money. Can they claim that loss on their taxes?
Actually, yes, but there are some important rules we need to talk about.
Okay, so walk me through this. How does the tax system handle inherited property?
When you inherit property, your basis, that's your starting point for calculating gains or losses, gets stepped up to the fair market value on the date the person died.
So if grandma bought the house for $50,000 but it was worth $200,000 when she passed, my basis is $200,000?
Exactly! That's why most people don't pay capital gains on inherited property. But if you sell for less than that stepped-up basis, you can claim a loss.
How do you actually report this?
You'll use Schedule D and Form 8949, the same forms for any capital gains or losses. If you sold for less than your basis, that's a deductible capital loss.
And that saves me money on taxes?
It can. You can use capital losses to offset capital gains first. If you have more losses than gains, you can deduct up to $3,000 against your regular income. Any extra carries forward to next year.
Wait, there's got to be a catch, right?
There is. This only works if the property wasn't your personal residence. If you inherited grandma's house and you lived in it as your home, any loss from selling it isn't deductible.
So it has to be investment property or rental property?
Right. The IRS only allows losses on property held for investment or business purposes, not personal use.
What paperwork do I need to keep track of?
The estate should provide you with the stepped-up basis information. Sometimes you'll get a Schedule A from Form 8971 that shows the value used for estate tax purposes. Keep all that documentation, you'll need it when you file.
Let me make sure I understand. If I inherit an investment property worth $300,000, but the market crashes and I sell for $250,000,
you'd have a $50,000 capital loss you can claim, assuming it wasn't your personal residence.
and if I don't have any capital gains to offset?
You deduct $3,000 against your regular income this year, then carry forward $47,000 to future years. Remember, personal use property losses aren't deductible, and you need proper documentation of the stepped-up basis. Also, some estates elect alternate valuation dates, which can affect your basis.
So the bottom line is yes, you can claim losses on inherited property, but only if it's investment property, not your home.
Exactly. And as always, complex inheritance situations should be reviewed with a qualified tax professional.
Thanks, Sarah. If this helped answer your inheritance questions, hit like and subscribe for more tax conversations that actually make sense.